Hello there and welcome to FX Street Currencies in Play, brought to you by Royal Financial Trading. I'm joined by Jeremy Stretch, who is head of G10 FX at CIBC. I can never forget that.
Indeed you cannot, Zach. Good morning.
Okay, so we had the Fed last night giving people a bit of a jolt. So some individuals, I'm not going to say experts, but some individuals were suggesting that the dollar had bottomed out yesterday, and therefore there wouldn't be any of the sparky type of activity that you saw on the Aussie, sterling, and the euro.
Well, it was.
Is that the last gasp?
I don't think it is the. I don't think it is the last gasp. I think it was one of those fascinating sort of throwbacks to history, because in a sense, reading that statement was rather like a lesson in English language, because you're having to go back to the Greenspan era, where you're comparing statements and seeing which nuance of which word has subtly changed. And in a sense, there were some subtle changes in relation to the inflation complex and also in relation to the balance sheet, which have led markets to assume that there is a small chink of dovishness in the statement, in the same way that the market read the small hint of hawkishness from Draghi the previous week in terms of a reason to buy the euro in the context of the dollar. Markets have looked at the language and said, well, there is an opportunity maybe for the Fed to push back from September to November in terms of the balance sheet, and if that's the case, then the probability of a rate hike this year diminishes accordingly, and hence we've seen some substantial levels taken out in the euro, in the Aussie, in the CAD, in the Kiwi. So there's been a fairly significant reaction, because markets have interpreted this as a small chink of dovishness from the Fed.
And but wasn't the real highlight there really the puncturing of the QE balloon, which is slow? It's just like a slow release they're trying to manufacture here, and that was maybe the reason why you had that dollar.
It may well be. I mean, I think in a sense in that context, we're looking at the twin factors in terms of the Fed. One is if they are going to follow through with that third rate hike this year, and of course that's debatable in the context of some of the recent data, but also in the context of the balance sheet reduction. And we've been waiting for this for some time. As I say, that reference to fairly soon is opaque enough to give the Fed a little bit of wiggle room. And of course, a central bank never likes to be painted into a corner. So we've got this fascinating scenario that as we go into September, we have the ECB suggesting they're going to be looking at their own tapering discussions and announcement in the autumn. Well, again, that's a movable feast, is that September or October. And at the same time, we've got the Fed saying we'll be adjusting our balance sheet fairly soon. Again, enough wiggle room just to give the market just a little bit of interest in terms of the timing.
And luckily the Bank of England would never make that sort of schoolboy error by boxing themselves into a corner regarding interest rates.
Absolutely. Of course not. I can see with a smile on your face, you know full well that the bank have done that on occasion.
There's no corner to be boxed into.
Well, one would hope not, but clearly, markets will be looking towards next week's quarterly inflation report and rate decision with particular interest. I think it's fascinating that obviously the growth forecast that the bank have been working with, which they upgraded back at the beginning of the year, now look rather too optimistic in the context of a 0.2 and then a 0.3 growth trajectory in the first half of this year. So that makes it increasingly unlikely that 1.9% target that they have for the year as a whole will be met. And I think that gives the bank an obvious opportunity to say, well, there is no need or there is no propensity to hike rates at this point. So I think we continue to see rate expectations moderated accordingly.
I'm going for 1%.
1%.
I think we'll be lucky to avoid a recession. But anyway, let's have a look at the real headlines, not the fantasy of somebody who doesn't not an expert in economics. Euro dollar firmer above 117 post FOMC, no signs of exhaustion. 120 question mark.
Well, in a sense, I think going through that 117.14 level was significant yesterday, and it would be important to see whether we continue to hold above it today. We've already had a brief flirtation through it, but without any real conviction. I think if we can break up higher, then we start to look at 118, 118.77. I think the big level on the top side, which people will look at, and it's rather interesting in the context of this week, is 120.43. Now that comes from 2012, July 2012, in fact, just 2 days before Draghi made that infamous whatever it takes speech, which of course it was the 5th anniversary of yesterday. So in a sense, we're going back to 2012, and 120.43 seems likely. I guess the question is, it's the pace of the move that might be starting or will eventually start to cause some consternation from the ECB. But Novotny was talking about overnight, the distortions of negative rates, and that underlines the fact that the ECB are perhaps mindful that there is no longer a need to have that expansive policy.
Okay, on to dollar yen, which is looking soggy. It was looking particularly soggy last night, but it seems to have slightly unsogged itself, if that's the probably the wrong word, I would have thought. But currently around 111.27. So any dips below 111, which I think was the wisdom earlier in the week, below 111 looks like a dip to buy into. So far that's working, but there was a sharp move to the downside after the Fed, wasn't there?
Indeed, and I mean clearly, the reference point was, of course, the impact of Treasury spreads versus JGBs, with yields coming off, with that perception of a more dovish bias to the FOMC. We have seen dips down to sort of the 110, 60, 70 earlier in the week. I think that's probably the sort of level where there's a pretty reasonable line of support. So I suspect we will continue to see buying interest there. I think the question is, if we are going to see a more dovish Fed, does that imply that there's another boost to the equity market? If that is the case, then that's a risk-on momentum move, and I think that suggests that the dollar yen can get some momentum. But the question is, we need to break up through the 200-day moving average. That's around 112.12. That, I think, is a level that we need to close above at the end of this week if we are going to see further highs.
Okay, pound dollar capped near 131.60 post FOMC, which is basically, I suppose that's the bears of cable really don't want to see it go above that, do they? I mean,
no, they don't.
That's their line in the sand, isn't it?
We've been seeing sterling short positions paired aggressively over the course of the last few weeks. So a lot of investors have taken money off the table, certainly in terms of the context of the dollar, because of that dollar weakness, which is encouraging cable to go higher. I think there's still a reasonable degree of conviction about euro sterling going up, but if you think that euro dollar is going to 120 or higher, then it's tough to stand in the way of sterling in terms of cable being dragged in its slipstream, because it's probably going to be difficult, at least in the short term, to see euro sterling maintaining the sort of momentum we're seeing in euro dollar. And
finally, dollar index, which has been looking rather sad and abandoned, really. We went down to towards the 93 level. Major chart support around 92.50 historically.
Well, I think we could even go a little bit lower than that. I think we're potentially going back to sort of 91, 90, 92, the figure level. I mean, when you're looking at the DXY, of course, that's largely predominated by euros, but there are predominantly European currencies in there, which are all doing relatively well against an increasingly beleaguered-looking US dollar, with obviously Trump on the sidelines doing everything he can, seemingly to talk down the dollar without necessarily implying to do that. So I think that the path of least resistance is still a lower dollar. I guess the one caveat is that it's the pace of the move. It is the oversold nature of the DXY, or the oversold or overbought nature of a number of the dollar crosses, that may be the one catalyst that we need to be wary of. But of course, we get data tomorrow in terms of GDP, and if those price influences within the GDP print are soft, then I think markets will read that as saying, well, there's even less reason for the Fed to be in play, and the dollar will remain on the defensive.
Okay, let's have a look at the trade of the day, which you may or may not agree with. The euro-dollar, euro overextended at this point as technicals do not help the currency. Limited economic news to play a major role on the currency. Short below 117.10, stop around 117.25 and take profit around 116.80. So just a little, I suppose, a retracement of that.
Yes, it's a small. I mean, that looks like a small intraday correction trade. I mean, clearly, just before I came into the studio, I think the low had been around 12. So if I'm correct, we probably haven't, or you wouldn't have quite have entered that trade yet. I think there is a case to be made to see just a little bit of a correction, but I think it is nothing more than that, a correction in what still seems to be a broad uptrend as far as the currency pair is concerned.
Yep, low at 12.1. So no, it's not in there yet. Let's go on to the next slide. Trading positions, still long of, probably not as long as you'd expect, actually, though.
No, you would have thought that number would have been a little bit higher than that. I suspect the only reason it isn't higher than that is because of the magnitude of the move, and people are mindful of getting caught out and just taking some profit, perhaps.
Dollar yen, I think it was 60 or 65 yesterday, so it's gone less short, but that was actually predicting the fall in dollar yen, so congratulations to those people. Dollar Canadian, any new insight there?
Well, I think it's going to be fascinating because we get the May GDP print tomorrow, and we've broken through a key level in the Canadian dollar, as we have in a number of crosses. That was at 124.61. So as long as we hold hold below that, and we get a solid GDP print tomorrow, and we're actually looking for an above expectations print, then I think the market is probably right in in predicting that the path of least resistance is probably still lower. I think there will be a point when the Bank of Canada will become very nervous about the pace and the extent of the move, but it may well be the case that we need to see 122.80, maybe 123 the figure, before the Bank of Canada have an opportunity to come in and try and stem the slide in the currency.
And then the Aussie dollar, 57% long there. Again, it's a bit on the low side given the massive move that we had yesterday.
Indeed, and I think clearly we've seen moves over the course of the last week. We've seen the central bank in terms of DeBelle and Lowe trying to arrest some of those gains, but it's proving to be a rather thankless task. Markets, I think, are still predicating that the RBA will be rather earlier in terms of tightening as far than the market is currently thinking. So I would still prefer to be playing the Aussie dollar from the long side. So I would say that sort of 57% is a little bit on the light side.
That was a cruel move yesterday, and then an extra, just in case you were still managing to hold on to your short positions, another push to 80.60 as well in the middle of the night. So very, very powerful move there.
Indeed, and certainly we've been seeing some fairly significant volatility in these pairs, and I think that just underlines that investors are sort of jobbing around positions and trying to take profit, but also trying not to be stopped out in some of those trades that they still have reasonably a high conviction in.
Okay, let's go on to the next situation here. The economic calendar to finish off the show. Initial jobless claims at 1:30 and durable goods orders. Do you think that'll have much of a move?
Well, durable goods orders is one of the most volatile indicators on the data calendar. So one suspects, unless there's a really outside move, that probably won't have an impact. Jobless claims doesn't cover payroll survey week, so again, probably of limited impact. I think markets will now be sort of pausing for breath between the Fed yesterday and that first estimate of Q2 GDP tomorrow, where, as I say, it's not just the headline number that we need to focus on, but it's the price indicators. And I think that's perhaps going to be the more telling statistic as far as the market is concerned. We
shall see how that goes. Jeremy Stretch, head of G10 FX at CIBC, thank you very much for coming in.
Thanks very much.
Regards to the team. That's it for today's FX Street Currencies in Play, brought to you by Royal Financial Trading.